Good afternoon and welcome to the Hong Kong Green Finance Association's Transition Training Series, Session 2, Taking Action, Real Economy Implementation and Case Studies. My name is Jenny Lee, the Deputy Secretary General of HKGFA. This is the second of a series of transition webinars organized by the HKGFA's Banking Transition Planning Working Group, where industry experts will share their experience, insights and case studies on practical implementation of transition plans in a rapidly evolving landscape. In the first session, we launched the HKGFA Transition Knowledge Repository Hub, a publicly available resource of the standards, frameworks, and principles necessary for credible transition plans. And you can find this on the HKGFA website. Industry experts during the first session also discussed the investment opportunities, risks, and challenges for financial institutions in achieving net zero under the current economic and geopolitical environment. In today's session, we will take a look at the latest state of play for the transition from an investor and corporate perspective, the tools, metrics, and data that is available to help track, measure, and drive a credible transition plan, followed by a fireside chat with practitioners on how this is being implemented. Please be reminded that this webinar is eligible for CPT, and please complete the event survey that will be sent to you at the end of this webinar. To set the scene and provide a global perspective and a frame of reference on whether investors or corporates are changing their outlook on transition, I'd like to invite David Russell, Chair of the Transition Pathway Initiative, TPI, to provide the opening remarks. The Transition Pathway Initiative is a global asset owner-led initiative and supported by asset managers aimed at investors to help assess companies' preparedness for the transition to a low carbon future. So without much further ado, I'd like to pass the floor to David.
Thank you, Jenny, and good afternoon, everybody, or good morning from London. And thanks to the HKGFA for inviting me to present to you this morning. I'm going to spend about 10 minutes talking about the Transition Pathway Initiative and also why I think a focus on transition is important for both companies and investors. So a bit of background to the Transition Pathway Initiative, TPI. TPI kind of stems from the COP in Paris in 2015, where the word transition or transition to Paris alignment, transition to net zero became part of the lexicon of the need to manage climate change. The problem was that investors, asset owners in the UK as a start point, didn't understand or know how to assess how companies were transitioning. The only tool we really had at the time was carbon footprinting. And while there's a role to play for carbon footprinting in assessing how portfolios are exposed to carbon, that doesn't really give you much of a way of assessing how companies are transitioning. So this group of investors, a group of asset owners in the UK, got together and worked with the London Stock Exchange Group, FTSE Russell, as a data provider. We went to the market and said, can we have good pension? As most of you know, if you're an investor, pension funds don't like spending money. So we went to the market and said, can you give us data on how companies are transitioning? And FTSE Russell was the one that said, yes, we can provide you that data for free, and they still do. So we have a long-standing partnership with them. And we also worked with the London London School of Economics, excuse me. The London School of Economics to set up the TPI. The London School of Economics now has a TPI centre as of 2022, which has 30 people working on TPI related activities. There were a number of principles behind the project as we set it up. As Jenny has said, it's an asset owner led project. So the board that I'm chair of is made up solely of asset owners. The process we have for assessing companies is academically rigorous and independent. We work with the London School of Economics. It has an academic background and is very strong on making sure that all the research it does and assessments it does are assessment. We only use publicly available data in the assessment process. I think that sets us apart from many of the other climate assessment processes, ESG data processes, assessment processes out there. The processes we use, the methodologies we use for assessing companies are also publicly available, and we go through a rigorous approach to consulting around the development of those methodologies as we evolve them over time. And most importantly, the results of the assessments that we make are open access. They're freely available on a from a tool on the website, the TPI website, and that is to enable investors, whatever size they are, to be able to use the information. You don't have to pay to use it. Now, the initial focus we had within the TPI and the assessment process we had with the relatively small number of companies to start with was around the carbon intensive sectors, not surprisingly, because that's where we thought the biggest impact would be and is in terms of carbon emissions. The TPI is a two-step process, a two-step assessment process. The first is management quality. Basically, this is an assessment of how companies are governing their transition. And currently, we assess around 2,000 companies on this process, which is basically a step ladder from 0 to 5, level 0 to level 5, of 23 questions, which go from basically the company doesn't even recognize climate change is an issue for it, up to level 5, where we are assessing whether companies are putting in place CapEx for the transition, how they are dealing with offsets within their transition planning. So it's a focus from 0, no climate change is being even recognized as an issue for a company, up to they're putting in place transition plans and some of the details around the transition plans that are being developed. We have level 5 now. Level 4, we had originally levels 0 to 4. Level 5 was introduced because we were getting a clustering around levels 3 and level 4. So that level 5 is now a higher level. And as as companies begin to develop their transition planning, we'll continue to develop the level of detail we expect to be disclosed by companies in our assessment process. The second assessment approach is carbon performance. And carbon performance assesses the targets companies are setting in the short, medium, and long term against transition pathways. This approach currently covers around 500 companies. It's very research intensive. The work is undertaken by the team at the TPI Centre at the London School of Economics. It focuses on the 11 high emitting sectors. And within that, it focuses on the largest companies, the biggest market cap within those sectors. It assesses the company's targets against 3 scenarios: 1.5 degrees, 2 degrees, and basically country level targets, the NDCs that countries have to assess. It's target based because it focuses on the targets the companies are setting, because the reality is very few companies currently have transition plans to assess, hence the evolution that we've seen in the management quality score. It's only beginning to evolve because we're now seeing companies with transition plans. And the targets need to be short, medium, long term. That's 2027 short, medium is 2035, and long term is 2050. It's worth noting the TPI focuses in other areas as well. We provide the assessments for the Climate Action 100 Plus global investor engagement program, which currently we provide 165 assessments for their benchmarking process. We also assess banks, and banks are important in the transition because they may not be in themselves high emitting sectors, but they provide finance lending to companies which can be used for transitioning or can be used not to transition. So it's important to understand how banks are dealing with the transition. We currently cover 48 banks. And finally, we also assess sovereign debt and how countries are transitioning with the Assessing Sovereign Climate Opportunity and Risk project, which is now part of the TPI. And the analysis is done by the London School of Economics. There are 70 countries assessed there, and it's really important not only from understanding how sovereign debt is transitioning, but understanding how companies are transitioning, because obviously companies are based in countries, and where they are based will influence the level of transition that they are currently showing. How am I doing for time? Okay. 5 minutes. Yeah. Okay. So what we do then is we provide this information freely on our website. It's open access, and it's really important to understand that we just provide the information. It's up to investors how they are going to use that information. And so we understand and we know that they use it integrated into investment decision makings. They take the scores, the information that we have, and build it into their investment processes. It is definitely used in engagement, understanding, looking at the level of transition within companies, and then talking to companies about how they are transitioning, where their plans are to go in the future, whether they should be disclosing more, what their transition plans are, how their targets should evolve. So lots of different ways which TPI data are used in engagement. It's used in product development and indices. I said we have a relationship with FTSE Russell. FTSE builds a number of different indices around the world based on TPI data, which uses TPI data to highlight the companies that are transitioning or who aren't transitioning. And there are many billions of dollars now run against TPI-based indices. And the final area that it's worth thinking about in terms of TPI data is used for tilting portfolios or excluding things. And we know of examples of investors that take out the companies at the lower end of the scoring and tilt their portfolios towards the better performing companies, the companies that are showing more transitioning. So that's how the data are used. Where do we think TPI is going in the future? There'll be a better inclusion of transition planning in the assessment processes. When we started this in 2017, there simply were no transition plans. We're now seeing development of transition planning standards in the UK and in other markets around the world, and companies are beginning to put in place transition plans. So the assessment will evolve to better assess how companies are actually transitioning. We'll have greater coverage. We're expecting our management quality score to go up to at least 4,000 this year and beyond. So basically global market coverage within a short period of time. With our carbon performance scores, which are much more resource intensive, we're switching to an AI-based approach to assessing how companies are putting in place targets and how those targets compare to transition pathways. And we also expect to so that coverage will go up into the thousands as well. And finally, we also expect to cover private markets and credit as different areas. Our focus very much has been public equities and obviously sovereign debt, but we recognize we need to look at private assets because there's an increased focus from investors on investing in private assets. So that's a very quick run through of the TPI. What I'd like to do now is very briefly focus on why I think the transition is important. And I used to work at UK pension funds, and the focus in the past has very much been on we need to decarbonize our portfolios. We are where we are now, and we need to get to net zero by 2050. And that's relatively easy to achieve. You set yourself the targets with short, medium, and long-term targets like companies do. And then you put in place processes to achieve those targets. Now, getting to the short-term targets is relatively easy. You simply sell carbon-heavy assets. You sell the coal, you sell the steel, you sell the cement, and that is an easy way to actually reduce your carbon footprint. However, when you decarbonize your own portfolio like that, you simply sell things. Someone on the other side is buying those assets, particularly if it's public equities or public credit. You're not actually making any real world difference. You're just decarbonizing your portfolio. And I think, and as I said, that's relatively easy to do. And you'll see a number of funds around the world are achieving their short-term targets in terms of decarbonization. As I said, there's no real world impact there because all you're doing is trading amongst yourselves. So I think that the focus, what we begin to see a focus amongst asset owners and asset managers on, okay, how do we assess how companies are transitioning? And the focus then becomes on what are companies saying how they're going to transition, what plans they're putting in place to transition. And I think that's a really important shift in how investors are focusing on this. It's not just about taking carbon heavy assets out of your portfolios. It's about looking to make sure the assets that you're investing in are transitioning, and encourage those that aren't to transition. Because in reality, to get to net zero by 2050, you simply can't sell the carbon heavy stuff in your portfolio. The idea here is to address climate change, because that's the risk that investors are facing, and to address that risk, the whole of the economy has to decarbonize, not just your portfolio. So I think over coming period, we'll see a shift from simple decarbonization, selling carbon heavy stuff, to a focus on, okay, how can we make sure our portfolio is transitioning? And I'd like to leave it there. I think I've run out of time.
Thank you, David. Look, it's very positive to hear that actually investors are still very much focused on transition planning. They're taking positive steps forward. And more importantly, there is a TPI tool that's available, and that's free to access for the markets as well. And so with that, talking about data and access, I'd now like to pass the floor to Elizabeth, who is from CDP, and who will share some of the insights in terms of how CDP works with corporates, how corporates can disclose and utilize their data also to track climate transition plans, and also cover the latest trends that are happening right now from a disclosure perspective. So over to you, Elizabeth.
Thanks, Jenny, and thank you, HKGFA, for inviting me. I'm very pleased to be here, and thank you everyone for tuning in. First off, I wanted to echo David's message in the end there that transition plans is becoming increasingly important for helping brown industries transition to greener industries so that the entire economy as a whole transitions. And this is an area of work that CDP is heavily focused on in recent years. And I'm very happy to be here to surface and share our insights and findings based on the data that we collect. So for those of you who aren't too familiar with CDP, we are a global nonprofit that runs the world's only independent environmental disclosure system. We are founded 22 years ago and are backed by over 700 financial institutions with over 140 trillion in assets calling for the world for disclosure. Last year, over 24,800 companies worth 2/3 of global market cap disclosed through us. So what are climate transition plans? In the next slide, you'll see CDP's definition of one. I'll give you a moment to read through it, but in essence, it is a tool to guide companies to reach their long-term net zero target. Now, CDP has 6 guiding principles of what constitutes a credible climate transition plan. And I really want to highlight the first principle here, which is accountability, because accountability plays the most important role in determining whether a plan is credible or not. And we know this because companies who reported a public transition plan, which incorporated a shareholder feedback mechanism, increased from 26% to 63% in 2023. And this suggests that a growing number of companies that disclose to the majority of the key transition plan indicators, which we will get to in a moment, they have confidence in their plans due to strong accountability mechanisms. And in the next slide, you will see while different standard setters and initiatives all have their own definition of what a credible transition plan is, we are seeing that there is an emerging convergence around key disclosure indicators. And this table illustrates CDP's alignment across other frameworks and standards and initiatives. You'll see from the dark purple blocks that indicate that there is full coverage between the questions asked in the CDP questionnaire and the framework or standard. The light purple blocks indicate that CDP has partial coverage, whereas the white blocks mean that the mapped standard or framework does not require the disclosure of this information, whereas CDP's questionnaire does. You'll see that, for instance, the SEC guidance is veering quite far off from the rest of the players here. For instance, they don't require disclosures around value chain engagement or financial planning details associated with the plan. So all of this is to say, whatever elements these standard setters believe constitute a credible transition plan, the CDP framework covers most, if not all of them. And in the next slide, you will see that to help companies navigate this landscape, last year, we published our annual transition plan report, which introduced a 5-step transition plan journey. Each step is drawn from the experience of a huge section of companies from various industries. and it outlines a series of actions and disclosures that should be taken by any organization during the development and disclosure of their plan. And these actions are mapped to CDP's 21 key climate transition plan indicators, which we will see on the following slide. I'm not going to walk you through all of these indicators, but the point here being these indicators mapped to our 5-step journey really provides a structured pathway for organizations who can use these indicators to reflect on their location or maturity along this journey. So from the disclosure data that we've gathered in 2022 and 23, this graphic shows the percentage of companies disclosing against the 21 indicators in both years. And interestingly, these figures reveal key challenges our disclosures are facing. So for companies really at the very beginning of their journey, accounting for scope 3 and complete emissions verification continues to be a challenge, which is not surprising. And for companies on step 1, moving up to step 2, we see a lack of senior management incentives linked to transition plan performance indicators. For companies on step 3, moving up to step 4, we see companies falling short on robust engagement plans with their value chain, scaling of low carbon products and/or services, and policy engagement. And the main hurdle for companies at step 4 who wish to reach step 5, they must increase their disclosure of aligned, the spending or revenue aligned with their transition plan. And this is to demonstrate that their plan is sufficiently resourced. Now, based on our data, it is clear that the climate transition plan disclosure rate is increasing at pace. And while there has been a 40% increase in the number of companies disclosing that they have a plan, this number represents only a fourth of all entities reporting through CDP. However, what's interesting about this particular graph is when you add up the 2 columns for 2021, meaning companies who already had a plan in 2021, plus those that signaled that they would have a plan in 2 years, the number actually adds up to the 2023 figure of companies that have a plan in place. Hence, we do see companies, in fact, keeping their word, which is in itself quite promising. Then when we look at the different regions, we see Asia leading the way. For instance, Japan was the leader for the 3rd year in a row, with 32 companies disclosing to all elements of a credible transition plan. You'll see Hong Kong on the right there is not doing too bad, but we still have a long way to go. Most companies listed on their respective exchanges disclose to some or many of the indicators here. But in contrast, the entire CDP disclosure sample in 2023, which included listed and non-listed entities, only had 20% of disclosing companies situated within the some or many tier. And this disparity suggests that transition plans appear to be a higher priority for companies that are publicly listed. And this is expected, given the increased level of scrutiny and development of disclosure requirements that public companies are subject to. And as you all will know, large cap issuers in Hong Kong are required to report against IFRS S2 from 2026, which includes the disclosure of a climate transition plan. Now, when we look at various industries, we see power generation, financial services, and infrastructure continuing to demonstrate high rates of disclosure across all or many of the transition plan indicators. And our analysis suggests that maybe because these industries are subject to long-term financial and business planning, and therefore are more incentivized to think about how they're going to navigate the impacts of climate change very early on. And you'll see here that fossil fuel continues to lag across all indicators. Now, you might be thinking, well, that's all very interesting, right? But how does this information help me structure sustainable finance products, such as SLLs? Well, here at CDP, we see SLL offerings as guided by 3 pillars. The first pillar is scores. Scores which give you a very broad understanding of the company's performance, but really doesn't provide any more granularity beyond that. The second pillar would be transition plan indicators, which tell you the maturity level of a company and whether they have a credible plan in place to reach net zero in the long run. The third pillar is emissions intensity metrics, which tell you the interim progress that the company is making. But unfortunately, not all intensity metrics are made the same. And when companies within the same sector are reporting different intensity metrics, it's very challenging for FIs to benchmark performance. So on this basis, we released a report brief last month, and we used CDP data to answer questions around the availability of these metrics and how they're measured. And we found that among the indicators available to FIs, physical intensities emerge as really critical to identify efficiency gains and compare company performance amongst high-emitting sectors and sectors with homogeneous outputs. Unlike absolute emissions that require at least 2 years of data to allow for trend assessment, physical intensities really enable point-in-time assessments of a company's performance. We also found that using emission intensities as an indicator within transition finance offerings prevents companies with the least carbon-intensive production processes from being penalized for increasing their absolute emission if they gain market share against lower-performing companies. And while a common practice is to use financial metrics such as revenue to create GHG intensity ratios, metrics dependent on prices tend to be much more volatile than those based on physical outputs, making them really less accurate for benchmarking company performance. So given this and the fundamental link to physical production, physical intensities are most appropriate to inform sector-specific analysis. And on the next slide, we'll see that our data shows that over a quarter of companies report having intensity-based targets. However, less than half of these have intensity targets that use denominator metrics that can be mapped to IEA variables. So as you can tell, without standardized approaches, it's very difficult for data users such as FIs to compare companies to their peers within their sectors. So in this regard, we see and we believe FIs can play a really important role in driving the adoption of comparable intensity-based targets through engaging and educating their investees and borrowers. Lastly, I have this slide with some of the resources that we have around transition planning and transition finance, including the report that I just covered and the physical intensities report brief. And lastly, my email is here for anyone who wants to get in touch on any of the content I've just covered. I appreciate that was a lot to digest and I went really fast, but thank you all for your time, and I'll hand it back to Jenny to introduce the panel.
Great. Thank you, Elizabeth. And if anyone on the call has any questions, please feel free to also reach out to the Secretariat. We'd be more than happy to put you in touch with Elizabeth. With that, Serena, I'll pass the floor to you to basically kickstart the fireside chat.
Okay, no problem. Let me just quickly check that I still have my fellow panelists over here, which I think should be the case. Let me take a quick look. There we go. Great. So good afternoon, everybody. My name is Serena Mag. I'm the Executive Director of Sustainable Finance at DBS Hong Kong, and I'll be your moderator for today's fireside chat. Now, the theme for the discussion is taking action. So we've heard from David, from Christina about all the tools, all the data, and so we wanted to dive a little bit more into tools. What does it mean for Asia? Is there any real case studies from practitioners, just for us to learn a little bit more? So we're very, very fortunate to have a good panel of speakers, and we welcome David back to join us in this panel for today, who will share their experiences on this topic. So we know companies need to deal with evolving climate-related disclosure requirements. So transition plan is the beginning of all the actions. So we think this is a super important topic for us to consider. So for this fireside chat, how this will work is that we will first invite the panel to share their insights on this topic. Then we'll dive deeper into the business case for such transparent reporting. That will follow by a practical case studies from practitioners, as well as tools available that can drive the real-world implementation, which is also the second part of the theme for today. Now, finally, hopefully we wrap up with some recommendation and actionable steps that companies can take to accelerate their net zero transitions. Now, I think Jenny was alluding to this earlier, but for the audience, we look forward for this chat to be interactive. So please type in your questions. I see a couple already in the Q&A box, so please keep it coming. We will try our best to weave it into the conversation as we go along. So without further ado, let's very quickly get started. And with that, may I please invite our first panelist, Ms. Christine Lau, Vice President, the Stock Exchange of Hong Kong Limited from the HKEX. Christine, the floor is yours.
Hi, hello everybody. Good afternoon. First of all, thank you HKGFA for having me here today. And my name is Christine Lau. I'm from the policy team of the listing division of the Hong Kong Exchange and Clearing. My team oversees the development of the ESG reporting framework under the HK listing rules. So as some of you may be aware, our new climate disclosure requirements under the Hong Kong listing rules have came into effect this year in January. So the new climate requirements were developed based on the IFRS S2, and they form part of the wider Hong Kong roadmap for the local adoption of the ISSB standards. Under the government's Hong Kong roadmap for sustainability disclosures, all large publicly accountable entities, PAEs, which comprises large listed companies and financial institutions carrying a significant weight, are to fully adopt the ISSB standards by no later than 2028. And the new climate requirements under the Hong Kong listing rules represent the first step to prepare our listed companies towards eventual sustainability reporting in accordance with the Hong Kong Sustainability Disclosure Standards, which were published by the HKICPA last December. And the Hong Kong standards are fully aligned with the ISSB standards. So today's topic is our net zero transition. I would recall that under our new climate requirements, which is based on IFRS S2, companies are required to disclose any climate-related targets, such as GHG emission targets, or such targets that the issuer is required to meet by law or regulation. And companies are also required to disclose information on transition plans, if it had one, to move towards a lower carbon economy. Since June last year, the IFRS Foundation has assumed the responsibility for UK's Transition Plan Task Force disclosure framework and related guidance. In the near term, the Foundation has indicated that it would use the TBT disclosure-specific material to develop educational materials to support users and preparers of transition plans disclosed under the IFRS S2. And in the longer term, the ISSB will consider the need to enhance the application guidance within IFRS S2. As Hong Kong is moving towards the full adoption of the ISSB standards, these developments regarding disclosure of transition plans are relevant to large PAEs in Hong Kong. And you will also note that Hong Kong is not alone in moving towards the full adoption of the ISSB standards. Many other jurisdictions are also moving towards ISSB adoption. And even if you are not a regulated entity in these jurisdictions, you may be a value chain partner, a supplier or so of a company that is subject to the relevant requirements. And when your major customers is considering to net zero transition, they will look into whether you, as one of their value chain entities, is prepared to walk the journey with them. And you will also know that many governments have already set carbon neutral targets. For example, in Hong Kong, the government has targeted to achieve carbon neutrality before 2050. And the PRC government has also targeted to achieve carbon neutrality by 2060. So companies will need to consider the impact of regulations or policies put forward by governments of jurisdictions that they operate in to achieve the carbon goals and plan accordingly. While it may be costly and require dedication of a lot of resources to develop the relevant plans, systems, and infrastructures, your preparedness and readiness may eventually become your competitive edge. So we do urge companies to take decarbonization seriously and develop a well thought out plan for it, as this goes towards your company's competitiveness in the long term. And last of all, transparency is also very important. We do hear from investors that they would like to know how well prepared a company is towards climate risk. And we take that into account when making investments, especially long-term investments. They want to see how the management views climate change, and a board that is well prepared and demonstrates leadership in this area would definitely boost investors' confidence. So that's all from me now, and I look forward to share more.
Thank you very much, Christine. One thing that caught me was the preparedness becoming a competitive edge, which I'm sure we'll come back to a little later. Now, our next panelist will be Mr. John Haffner, Deputy Director, Sustainability of Hang Lung Properties. We will look forward to your insights. John, the floor is yours.
Thank you, Serena. Thanks to HKGFA for the invitation. Glad to be here. So I'd like to take people through a few slides quickly on what we've been up to at Hang Lung. We just published our sustainability report, but at the same time, we also published a paper called Our Journey to Net Zero. I would encourage people to take a look at it. We learned a lot from this process. So I sort of want to walk you through what we did in the paper, the methodology, some of the insights that emerged as it relates to this broader transition planning discussion and taking action. Next slide, please. So, oh, there's a QR code there. If maybe we could just pause on that for a moment if people want to click on that, or you can also just find it on our website. So just hot off the press last month. Next slide, please. So what were we doing with this paper? We wanted to analyze and communicate scenarios in the path to achieving net zero, improve our understanding of decarbonization challenges and opportunities, and advance industry discussions and collaborative efforts. So the word transparency was used already. We try to be very transparent in this paper. Next slide, please. So it's a 3-chapter paper. The first chapter talks about where we are today. And we use 2023 as a starting point, where we have actually a million tons of CO2 equivalent. And we, in the very short term, as we say transparently, we are going to reduce emissions because of renewable energy and less construction looking at the next few years. We focus 2030 to 2050 to understand how does the outlook, how do things evolve beyond that? And we had 2 main scenarios, and we found, based on a detailed model we developed, that emissions will drop from about 1 million to below 100,000 tons in 2050. And of course, we want to try to get it all the way to zero. We'll talk about that a little bit later. How much construction we're doing in real estate is a fundamental variable, obviously, for us and for other real estate developers. And some key trends in technology will make a difference. We talk about actions that we're pursuing and some rules and that will also impact on what gets credited and what doesn't get credited and so on. So that's the broad framework for the paper. So yeah, next slide, please. So we did a bottom-up model, more than 1,000 inputs. So for example, what does the China Iron and Steel Association say the emissions intensity of steel will be in 2050? That's an input. Our floor area, our current energy use intensity, and so on. And then we developed 2 scenarios with 30 key assumptions that are laid out here in order to develop these scenarios into patterns that provide materially significant results. Next slide, please. So we had multiple sources, both internal and external. I just gave an example of one of the reviewers' comments. There was some discussion internally with some of my team members on why are we doing scenarios? And I think the answer in short is, if you're looking out to 2050, you ought to be doing scenarios, because, from a financial perspective, we wouldn't say this is what our revenue is going to be. Stop with decarbonization as well. I think we need to allow for scenarios that can impact on the pace and speed and completeness of the journey. We had a number of different reviewers that gave us good feedback as well. Next slide, please. So then you can see the trajectories. We isolated what if we did no new construction, just to understand the impact of decarbonization on our existing portfolio. And then we brought in assumptions around construction under these more or less optimistic scenarios. And then you see the reduction by 2050. Next slide, please. So then we talk about the actions that we're pursuing. This is not comprehensive, of course. Our sustainability report talks about others, but the idea was, what are some of the fundamental actions we want to be pursuing over time that will make a difference? And so I think probably there's not a surprising list of actions, but I'll talk a little bit more later too, if we have time in the discussion on some of these actions. But renewable energy is a big one in China. There's so much good momentum there. Reducing the GHG intensity of construction materials in collaboration with tenants. I'll give some examples on the next slides. So we now have 5 of our operating properties powered by renewable energy, and I can tell you that we are optimistic. Stay tuned that number may increase. So stay tuned for more on that. We're optimistic. But China is doing so much renewable energy that really helps, and it's appealing to our tenants. On the steel side, we did a low carbon emission steel transaction. And if you look at our press release, we're very transparent about the baseline we're comparing against. It was third-party verified, working with Bao Steel. We're very proud of this, because this is really going into the procurement process in real estate and working with a supplier to reduce the emissions intensity of steel. Next slide, please. Tenant partnerships, very important. We need to take a whole building approach to decarbonization. We share the same space. So we had a 2022 partnership with LVMH, learned from that, launched a broad program at the end of 2023. Last year was our pilot year of that, and we really see that as really critical for driving decarbonization as well. And one thing I want to highlight in the built environment, if you look at the emissions from interiors, from renovations and fit outs over the life of a building, they're higher than the core and shell. People don't realize this, but it's something we're not even required to report yet. I think in the future, perhaps once we get better at this, everybody should be reporting on this. So we're working with tenants on embodied carbon benchmarking. And here's an example from the Center for Asian Philanthropy and Society, where they were using the Giga standard and doing well against benchmark. So we want to ultimately gamify this process with tenants so that everybody can drive down the embodied carbon at fit-outs. On the net zero journey, I don't know, people saw President Xi's comments last night or this morning. A very strong reaffirmation of China's commitment on decarbonization. You know, we've been wrong before where we've said solar EV batteries are only going to develop at a certain rate, and China's exceeded expectations in all cases. The great and exciting question is, could that now happen for the hard to abate sectors? Could China turn its sights to steel, cement, aluminum, etc.? And if so, that'll make a big difference to our indirect emissions, which are a large share of real estate's overall emissions. So we discussed that in the paper. We don't build that into the model completely, but we allow for that as giving wind at our sails beyond the model results. And I think that's it. I'd love to share more, but in the interest of time, I'll stop there and happy to share more in the discussion. Thank you.
Thank you very, very much, John. I'd love to listen to this for another half an hour. I'm sure I'll have a lot more questions, but please keep the questions coming. If there's anything that you'd like to know more from John's presentation, please put this into the Q&A box as well. And John, I have to say, you actually you stole my cue card. I actually had President Xi's comment somewhere in my queue, the scene setting in the next one, but I'll read it out anyway in the next one. No worries at all. I think it is an important scene setting. So up next, we're very delighted to invite Mr. Jeffrey Lee, Senior Vice President, Sustainable Finance and Head of Assessment from APAC Moody's Rating, to share with us about the insights on transition planning. So Jeffrey, over to you.
Hello, and thank you for having me today. Very delighted to join this webinar series with Hong Kong GFA. I mean, obviously, I think we have heard a lot from David, John, and Christine about transition and the importance of the transition planning. But just to reiterate, to start and setting the scene is that, I mean, obviously, the world is facing a 2.4 trillion climate mitigation investment gap, according to IEA, as well as our own studies. And a lot of governments and public entities are challenged with heightened government debt ratios and implementing and narrowing this gap, climate change mitigation gaps. Separately, according to our own studies, and this is based on our rated debt universe, around $4.2 trillion worth of debt is facing a climate quite a heightened level of transition risk, meaning that many issuers will have to think about how will they navigate through this transition planning to get to the other side of the world. And I mean, obviously, we have seen that the private sector has been helping this, and namely that sustainable finance debt markets, where my primary mandate is to provide transparency into this sustainable debt markets. And we have seen fantastic growth in the past 5 years. Now the market has settled at a level of like a $1 trillion US dollar level on annual issuance levels for the past few years. However, at the same time, I think we have also seen some reluctance in some of the more innovative products among the sustainable finance debt instruments, namely the sustainability-linked products. We have seen a lot of growth in the SLL side. I guess Serena has a lot to say on that. But if you look at the SL bond market, the public bond market, I think SLBs have been facing quite some challenges there. Alongside with that, I think many governments as well as institutions are trying to push for transition labeled UOP bonds. However, the tick-off outside of Japan has been quite slow. And I think fundamental question that I hear from lenders as well as investors and other issuers is that fundamentally you're financing brown assets or transition assets, as well as your financing general corporate purpose financing through SL instruments. But do you have a plan? We get to this point that many investors and lenders are asking, do you have a plan? And how does this financing fits into your overarching strategy of achieving a certain outcomes? So this is how important it is for issuers, not only on debt capital markets, but also I believe the same is happening for the equity markets as well. The setting up of a transition plan and transparent communication with your investors and lenders and other third-party providers like us is something that it's getting more and more important. And our job at Moody's here is, as like we have done in the credit ratings, we want to be a bridge between investors, lenders, who are the users of our assessments products, and the issuers who can be those who wants to access to sustainable finance debt markets. So we have launched a product called Net Zero Assessment, which is a transition plan assessment. It's a deep dive engagement product. So we're not only relying on public information, but similar to the ratings exercise, that we'll be sitting with the company for around 10 weeks to hear about their plans and transition plans, ambitions, their implementation strategy, as well as what the governance structures are. So I'll stop here. I mean, it's an opening remark, so I won't go too much into what Net Zero Assessment provides, but I'll stop here and see if we can further discuss later on.
So thank you very much, Jeffrey. I think you highlighted very well the financial risk associated around transition risk and climate risk, and also highlighted the importance of transition planning. I'm sure we'll come back to the Net Zero Assessment to a little bit later down the panel. So thank you very much. Now, last but not the least, very much welcome back Mr. David Russell, Chairman of the Transition Planning Initiative. David, the floor is yours. I know that you've already given us a very, very helpful 10-15 minute overview of it, of TPI's work. So I just wanted to see if there's anything that you'd like to add in Asia context, anything that you'd like to highlight before we move into the panel. So the floor is yours.
Sure, thank you, Serena. And I actually wanted to build on something Jeffrey just said. You have to think why asset owners in particular are interested in transitioning. And it's based on many asset owners are now doing a climate scenario analysis of their own, let alone what their companies they're investing are doing in terms of scenario analysis. And the scenarios, we can question the quality of the scenarios and some of the data, but in general, climate scenario analysis shows that asset owners won't have as much money as they think they need in the future to pay pensions if climate change happens as the scenarios predict it's going to happen. So this is a risk management process for asset owners. So if you take it as that's why we're approaching it, or why pension funds are approaching it, how do you deal with that from a pension fund perspective? And my experience of working within a pension fund, we had our own in-house managers, and sitting in amongst the asset managers, they would much prefer to know where a company is going in terms of whatever the KPI, whatever the aspect of management of that company is, than where it was. So that's why there's a real important focus now needed on how companies are going to transition, where they are going. So forward-looking metrics of how they're going to manage from where they are now to where they need to be in 2025, 2027, 2035, 2050. So that forward-looking approach, a set of data, is really critical. And because I'd much rather make positive investment decisions, we want to invest in this company because it's going to transition, it's going to do whatever, then we need to take this company out of our portfolio because it's got a carbon heavy, it's got a big footprint. So having that information available is really important. And my personal preference has always been companies making those data public, rather than filling in questionnaires and providing it to a range of different data providers out there who then sell it on to investors. The more data that can be made public available, the more investors can see it and use the data to take their decisions. And it also feeds into a broader stakeholder understanding of where companies are going. So we definitely need more forward-looking data sets, setting targets, what transition plans are in place, how they're being delivered, in addition to the carbon footprint information, which is still valuable in terms of measuring where a company is or was usually a couple of years ago. But then that can be used in making positive decisions rather than a negative one.
Thank you very much, David. In fact, as we think about the disclosure, one thing that John mentioned that was the cue for the second session was the news that I was just reading of when I was having my lunch earlier about China reaffirming its commitment to the global climate goals, which I think is a very positive sign. Now, of which we already obviously know that Asia plays a critical role in global transition to a low carbon economy. So that's where the planning and the disclosure of the plan and the communication to the investors becomes super important. So I wanted to spend some time, maybe David, with you to understand, like zooming a little bit more to Asia, right? From all the work from TPI, is there anything that you can share with us about Asia's data disclosure, like from your working with Asia-based companies, etc. And why is it important for companies to disclose? Because as we were talking about it in the pre-call, what we also wanted to drive at this panel is the what's in it for the company. So why do they need to disclose? What's the benefit for them? So maybe David, if I can, ask you to help us as the kickoff for the first panel question.
Sure, and forgive me if I start reading stuff because I can't always remember the numbers. So TPI, and I'll focus on the management quality score because that's the governance of how companies are transitioning. As I said earlier, we covered just over 2,000 companies, of which 41% of those companies are Asia-based. That compares to 34% from the US and 16% from Europe. So there's a strong focus within the TPI and management quality data set on Asian companies. Why? Well, as I said earlier, one of the key drivers for focus of our initial assessment process was carbon intensive sectors, and a lot of those are found in Asia. So that's why there's one of the reasons why there's a strong focus on a strong percentage of Asian companies in our assessment process. The average score in our 0 to 5 process for Asian companies is 2.6, which is kind of in the middle, but that compares to a 2.9 for the global data set. And of course that's skewed, but because actually there are certain regions, the Middle East and North Africa, where the scores are very much lower. So Asia does well, but not quite as well as a global average. And in that, remember, it's a public data-based process, so it means that doesn't mean companies aren't doing more than the 2.6 would indicate. It just means that we're not getting the information from them. There's less public information from Asian companies than there are from European companies, for example. Hence the need to my key message of publishing more information about what you are doing, because that helps investors understand where you are going. Something else to add in terms of how to improve your transition planning. Well, the management quality process, and it's publicly available, as I said, is 23 questions, which gives you an idea of what you should be doing within your transition planning process. It's a checklist that companies can use and follow to, okay, if we do this, if we do this, if we do this, this will strengthen our approach to transition planning. And when we do that assessment, for Asian companies, a third of companies are levels 1 and 2 in our assessment process. That means acknowledging climate change is a risk for their businesses, and then in building internal capacity. Just over 50% of Asian companies are level 3, which is they're integrating climate and transition planning into their operational decision making. To put this in context, for Europe, only 2% of companies are levels 1 and 2, and 50% of companies are levels 4 and 5. They have a strategic assessment of climate change, and they're putting in place transition planning and implementing that. So there's a much higher focus on the delivery of transition rather than the simply acknowledging and building capacity than we're seeing in Asia. Yeah, so as to kind of close off, using the TPI MQ process is a good way for companies to understand how they can improve their transition planning. So yeah, I'd leave it there.
Thank you very much, David. It was a number that caught me was the 2% in level 1 and 2 for Europe versus 1/3 for Asia in the more acknowledgement level. So I think that calls for some work to be done.
Yeah, I think it's also a climate has been a much stronger focus in Europe from a political and from a corporate and investor perspective than it has been in many other markets around the world. So I think there's a catching up to do, but I think that catching up is happening very quickly as companies around the world, investors around the world, and governments around the world realize we actually have to do more to be addressing this investment risk, which is climate change.
Which actually leads us very, very smoothly into the question for the regulator. We know that I think there is, not a lot of publicly available information for Asia, as David was alluding to. So maybe for me, it's actually great to get the regulator's perspective on, transition planning and climate-related disclosure. So maybe Christine, if I can turn over to you, can you maybe share with us a little bit about why do you think standardized data disclosure is critical? And in addition, have you actually heard from the investors about their view on regulated disclosures?
Yeah, absolutely. Well, as a market regulator, our role is to ensure that there is an informed market for investment decisions to be made. And about informed market is about any information that the investors will find useful. In the past, it would be more on the financial side, and nowadays it would be more information on the climate disclosures is in big demand. And having a common language for sustainability information, it's very important as it allows comparable and consistent disclosures, and this enables pricing in of sustainability-related risks and opportunities and facilitates data collection and analysis. So we were used to having a few sets of standardized data sets for our financial reporting, and we have seen the benefits, and I'm sure we will similarly benefit from having a common language for our sustainability disclosures as well. And so for Hong Kong market as a whole, aligning our regulatory framework with the international best practices is essential to maintain our position as an international finance center. So for the investors, so I recall that back in our consultation last 2 years, the investor community has been a strong advocate for our proposal to follow the ISSB FRS S2 standards in preparing coming up with our climate-related disclosure requirements. And the views was that globalization has resulted in a more interconnected international environment. And this makes the standardized data disclosures more important, both from a strategic and economic perspective. And they also emphasize that domestic regulation should to the extent practicable, align with the international best practices. And what we also hear is that this benefit is not only for investors. In fact, some multinational companies have also informed us that they welcome our new requirements, and they are happy that Hong Kong as a whole is moving towards the full adoption of the ISSB. And that is because a lot of these companies, they operate in different different countries, and they are required to comply with multiple regulations and disclosure requirements. And they see a lot of challenge in trying to navigate the different requirements and doing a lot of mapping. And sometimes they may even need to prepare different versions of the sustainability disclosures. So they are happy with having one set of standardized data disclosure.
Thank you very much. I cannot imagine having to prepare 10 different kinds of disclosure reports depending on where the company is operating. So I am sure that the MNCs will welcome that. And it's actually great to see that they are also sharing the feedback to regulators such as the HKEX about how they welcome the disclosure rules to be put in. So on that note, in fact, we now have the context around how, why it is important, what tools are available. And remember, our theme was taking action and implementation. So allow me to share a little bit more about, a research paper that KPMG and DBS did a while ago. So we deep dived into a couple consumer goods sectors, and we found that for transition planning, there were gaps in data, knowledge, and finance that are hindering their decarbonization journeys. And from there, we kind of see that half of the companies we surveyed are still silent on Scope 3 emission reporting, which account for a majority of their greenhouse gas emission. So it might be attributable to what the speakers was mentioning earlier about long value chains or difficult to gather information. We saw in Q&A earlier about how we should collect data for such requirements, which we'll come back to later. And additionally, only 10% of the companies we surveyed have mature transition plans in place. I think that also corresponds quite well with some of the speakers earlier about the need for more credible transition plans. So with that, I think what we wanted to kind of dive into is more practical case studies. And also we understand what the tools are available. We just heard from David, there's a TPI checklist where companies can use to kind of gauge where they are. And on top of that, we wanted to understand how actual companies are dealing with these kind of issues. So with that being said, John, thank you very, very much for the insightful sharing just now on Hang Lung's journey for decarbonization. Can you maybe share with us a little bit more on the practical experiences, how you're engaging the suppliers, for example? We heard earlier that there was a very good initiative on steel. And also maybe we understand that there's always a question about the return on investment for sustainability investments. So can you maybe share with us how do you deal with that question?
Sure. So first of all, with regard to suppliers, again, in real estate, I mean, indirect emissions are a very large share of the real estate sector's emissions. So it's very important to engage with suppliers. We joined the Steel Zero initiative, which is under Climate Group, which commits us to steel decarbonization targets at the end of 2023. And the decision to join was that it would move us from a passive to an active role, that it was the underlying concept is to provide a demand signal. What we learned from steel suppliers is that they hadn't heard a clear demand signal from real estate as they'd heard, for example, from the automotive sector for lower carbon emission steel. So then, having made that public commitment, we started reaching out to steel suppliers in the mainland because we have an upcoming project there, our Plaza 66 Pavilion Extension project. And we found that there were suppliers that could potentially provide us with lower carbon emission steel. And then we brought that into our tendering process and we said, let us know how much you can reduce emissions by against what baseline and at what cost. And so we brought that into our procurement process for the first time, and we were able then to have all of our above ground structural steel and rebar procured with 35% embodied carbon reduction compared to Bausteel's conventional steel of the previous year. And so the methodology is laid out and is TV verified. So that was a great step forward. Now, as a share, I mean, there's still so much more to be done, but we don't get to zero carbon steel overnight, right? And so we got some good feedback on that. We've also done lower carbon concrete, very small overall emissions reduction, but proof of concept for lower carbon, where the mineralized CO2 is brought into the process in our Westlake project. So we've been working with suppliers for proof of concept, or in the case of Bausteel's transaction, much larger reduction. With regard to ROI, it's a big question. I'll give it a short answer. A couple of thoughts. One is that we're not going to be environmentally sustainable if we're not financially sustainable. So our board and leadership are very mindful of the need to be disciplined, and we need to think over time how this can be credible and sustainable from a financial perspective. One insight that was very helpful internally is to differentiate incremental cost from total cost. And what I mean by that is if you're replacing a chiller, but you have to replace the chiller anyway, then you don't have to position 100% of the chiller replacement as your transition cost or your decarbonization cost. You can simply compare the more efficient chiller against an alternative chiller and the incremental spend of that more efficient chiller when you're looking at the ROI. And so maybe there's a different CapEx up front, but there's a payback for that. And that's a different way to position ROI considerations. Now, the other thing I would say is that works for energy efficiency. For some of the construction work that we've done, there has been an incremental cost, but it's one that our board and management's been willing to support because we've said in the broader context of what we're trying to do, we think it's reasonable, but we're disciplined about that. And so there's obviously a limit to how far we go with the incremental spend.
Thank you very much, John. Jeffrey, if I can kind of also pick your brain a little bit. You were mentioning about net zero assessment tool, where you go deep into a company's decarbonization plans, and hopefully like it gives some insight for the company on what they needed to do more as well, and also give some transparency to the investors, right? So maybe if you can share with us a little bit more about how does rating agencies can how can rating agencies help to provide transparency for investors on transition planning? And also another important question that is always on my mind, and do you think it actually influences capital flows?
Yeah, so just to start, just to share a little bit more about NZA first, our net zero assessments product, because there are numerous assessment products in the market at this point that looks into different transition plans. And for Moody's, we are focusing on three key pillars, one being ambition and implementation plan and governance. But looking at ambition, I mean, obviously, looking at John's previous earlier slide, that's the type of information that we exactly want from issuers and corporates, is that your reduction plans and how does that fit into your temperature alignment scenarios. So, for example, for Moody's, we are not only looking at 1.5 degree scenarios. We're providing our opinions based on 1.5 all the way up to 2.5, 2.6. Anything going beyond 2.6, we believe that there is no incremental efforts. So we're looking at from 1.5 to 2.6. And that is because we wanted to give that granularity to the investors and lenders to make that decision, because sometimes it's not only 1.5 scenarios that they want to finance. Some regional context, some sectors in hard to abate sectors, in emerging markets, frontier markets, 1.5 might not be realistic at this point in time. Maybe investors and lenders are willing to finance well below 2 or 2 degree scenarios up to their ESG risk appetite. Because again, going back to Dave's point, that at the end of the day, this is risk management. And depending on your risk appetite, investors and lenders should have a granular view of their target companies. On top of that, we have a very important pillar called implementation plan, and that's where we go back to again John's earlier remarks and slides, that Moody's sits with the company and break down your scope 1, 2, 3 in a short term and long term. What is your plan in order to reduce and meet your short-term and long-term targets with regards to scope 1, 2, 3. And while we do so, we look at your CapEx plans as well. Again, mindful that it's a material non-public information, so Moody's does not disclose this into the market, but we will look into some of your CapEx plans as well as your execution history. And while we do so, we not only have our sustainability analyst team, which is across the globe. We have about 60 plus sustainability analysts in my group, but we also have credit ratings analysts who has been looking into the company and the sector for 20, 30 years. So we do collaborate with the credit ratings analysts looking into the sector exposures, what are the technologies, is it reliable, what's the CapEx plans, is execution history reliable, and therefore we assess the overall implementation plan. And this is important because some company A might have very strong ambition reaching to 1.5 and got verified. However, after several years, the implementation might not happen. On the other hand side, a company B who might have less ambitious targets, let's say well below 2, but have a very strong implementation plan in order to get to well below 2. And after 5 to 10 years at 20, 30 or 40, the actual case for emissions that has been reduced might be actually much bigger at company B, despite the fact that they have very smaller ambition targets. So that was something that we wanted to capture. And obviously, while we do this type of exercise, we do want to look into the governance structure, meaning that do you have a CDP verification reports? What's your senior management KPIs? Is there a numeration or their compensation packages? Is it coherent with your overall overarching strategy? So we look at quite holistic kind of governance structures as well. So this is like our approach, and it's important that, you know, it's a deep dive engagement product. So yes, if Serena, if you come back to us saying, hey, Jeffrey, I need Moody's to give me NZA on 30 odd names, I'm sorry, I can't do that in the next few months, because it will be a very deep dive engagement product. And we do want to listen from the issuer, and we want to be the bridge to explain that to the markets and our investor community that, you know, we have been working with.
Thank you very much, Jeffrey. I do wanted to come back to you at another time. That is a great reminder for me, and also I think for the audience, understanding how the transition assessment is actually done gives you some insight as to how you can think about the planning of this as well. Now we move into the Q&A session right now. I think we've got a couple of questions in the Q&A box already. So a kind reminder for those of you who wanted to kind of ask a question, please feel free to type it up in the Q&A box. Now, the first question I think is around scenario analysis and the assumptions, because we always get so many different kind of lines looking at the modelings. And also, David, if I can just kind of borrow you a little bit on this one. The question is around scenario analysis and for financial institutions, right? And some of these kind of scenarios like NGFS, IEA, sometimes are not as dynamic. And we know that the world actually does change. So what do you share some views on how do kind of we think about transition readiness vis-a-vis, you know, what's happening around the world right now?
So yeah, so from a climate scenario analysis perspective, a bit of context. In the UK pension funds, large UK pension funds have to do climate scenario analysis. We have to report TCFD against TCFD. There's a regulation in place, and so my former fund has undertaken climate scenarios over a number of years. And I also speak to other pension funds around the world around how they view climate scenario analysis. And I think the safe thing to say is that there are issues with climate scenario analysis, and the question raises some of them, particularly they don't respond to short-term changes. There's a whole lot of other things they don't respond to as well. Physical risk is often not there. Tipping points are often missed, where something that changes in the climate that forces more climate change to happen, and therefore a bigger impact. So there are issues with scenario analysis. I think the underlying point to make is that it's not the actual numbers that come out of the scenario analysis that are important. It's the direction of travel that we should be focusing on. And all the scenario analysis I've seen tends to show that long-term climate change is a risk that needs to be managed by asset owners, asset managers, and companies. I know some investors are looking at shorter term, more narrative-based climate scenarios, and I know my former fund USS is working with Exeter University on how to take, rather than 20-30 year scenarios, how to look at scenarios over the next 5-10 years in a narrative approach. So yes, there are issues with scenario analysis, but the underlying theme is climate scenarios show that investors should be addressing climate change because it's in their interest to do so.
Thank you very much, David. And with that, we have actually a couple more questions around how data is actually being collected, and what's actually Hang Lung doing. So maybe John, if I can hand over to you. I remember seeing on the slides that there are many properties in China that are already running on net zero. So on top of that, I'm sure there's a couple more things you can share with us. And on top, there's another question around, you know, is there, you also in the slide mentioned that technologies will be one of the enablers for decarbonization. So maybe you can also speak a little bit about that point as well.
Sure. So with regard to data, a couple of things to share. One is with where you have a functioning BMS. I mean, some of our older properties in Hong Kong are quite old, but so when we don't have updated BMS in some of our older Hong Kong properties, but mainland properties, I think there's a big opportunity with AI. There are technologies that can plug into the BMS and do optimization of the building. So we're looking at some options around that. I think that's a very promising area that will improve performance, but obviously also with that you can also get better data. The other area that I would highlight in terms of data, we're working with a group called EC Digital that came out of the steel sector. It was a former, I believe, Baosteel executive together with someone from the Ministry of Information Technology in China, set up this company, and they take what they call a Lego approach, where they follow the entire manufacturing chain of steel. And because they have such very good knowledge of the entire manufacturing process, they can provide very precise emissions data at each stage of the manufacturing process. So I think we're going to see in China in the next few years very good digitized data quality for steel, and then they're also looking to apply the same learnings and expertise around aluminum and concrete. This has always been the big black box for real estate companies, missing particularly construction emissions data. But I think that's an area that will make a big difference. And then I think the second question was about what we're doing on the mainland, right? So obviously we take a portfolio-wide approach to sustainability. I'm dialing in from Shanghai. Tomorrow we're meeting with some of our tenants to recognize their participation in the Changemakers program that I mentioned earlier. The steel transaction I mentioned was in Shanghai. The concrete one was in Hangzhou. Our power purchase agreements were first in the market in Yunnan, Jinan, and Shanghai to do these power purchase agreements. And so we're actually quite engaged on the mainland, and there's a lot of momentum on the mainland, I would say. And of course, energy efficiency, retrocommissioning. So really working quite broadly across the value chain on the mainland and also with other stakeholders. So for example, with Tsinghua University, we fund research that isn't always directly applicable, but it's developing the kind of research basis for sustainability as well.
Thank you very much. Brought to you all the way from Hang Lung Properties in China. So, so we've actually got a next question, which I think is a very good one before we wrap. Are we seeing first mover advantages for companies who implement transition planning? Well, to me, the answer is obviously yes, but I'm, like your fellow moderator for the day. So Jeffrey, if I can ping it over to you for some insights, please.
Yeah, I think the answer is yes. Given that at this point in time, what investors and lenders are wanting is the transparency, not a full alignment to 1.5. And I think that has been made quite clear multiple times from various forums. Yet in reality, it's true when I sit down with the CSOs and CFOs with the companies, they're worried about, okay, what happens if we don't get NZ1 or NZ2? What does that mean? What happens if I get an average score? What does that mean? But at this point in time, it's not really because we have very little supply in the market in terms of transition planning, meaning that I think investors and lenders will be very, very happy with NZ3, for example, as long as you provide that transparency to the market, because that's something that is lacking, especially around implementation. I mean, I think many companies have actually shown their ambition and targets. However, in terms of how you transparently communicate to the market is something that is lacking at this point in time. So I think there are definitely first mover advantages. If you think about the SLB market from today versus 2020, where 2021, the KPIs that has been used back then, think about it, Serena. I think no one can issue SL structures with the same KPIs anymore. So I think definitely similar kind of situation is happening here. But it's really that investors and lenders want that transparency at this point in time.
So answer one does or some kind of transparency does come in handy. And to have transparency, first of all, you have to have a plan. So with that, I think we have last 5 minutes left, and I'd like to maybe ask the panelists to help me here. We covered a lot of ground today: the why, the what, the how of transition planning, the regulation around it, why investors care about it, what can you do with it, technologies. And so if I can just borrow each of the speakers today to share one actionable step that you think that companies and businesses can do to accelerate their net zero transitions, and I think that will wrap us very, very nicely. Now, I think I'll just go with the list I see based on my Zoom sequence. And John, you're up next right after me. So can I ask you to start?
Sure. One actionable step. I mean, I really think it's been said before, but I'll say it again. I think data drives insight, right? So I think people should look for data to form big patterns where you can figure out, take an 80-20 approach, double click on the biggest areas of emissions. So, you know, business commuting is not our biggest issue. We know what our biggest issue is. Double click on, do your scope, your value chain emissions analysis. It'll tell you where your biggest source of emissions are, and then get started with small pilots on reducing those emissions.
Thank you, John. And Christine?
Hi. Yeah, actually, from what we hear from our issuers, a lot of companies, they often get overwhelmed and they don't know where to start. So I totally agree with what John just said, is like go through your value chain and focus on areas that are the most carbon intensive hotspots, and focus on these areas that can deliver results. And also the one thing I would like to remind is whatever you do, don't wait and start now.
Thank you. Definitely not going to wait. And then David?
Yeah, I think there's undoubtedly been some headwinds against how companies should be addressing climate change over recent months, not just from the US, where there's an obvious big political change there, but we're also seeing in Australia, in the UK, where certain political parties are pushing back. There's only one direction of travel here. We heard from China yesterday that they're still committed to addressing climate change, and they're going to release their latest NDCs at the COP in Brazil. And Christina's highlighted the regulations in Hong Kong around transparency. John said just now, data drives insight. So the more information that companies can provide on how they're transitioning, what targets they've set, and how they're going to achieve those targets, the better insight that investors can have around what they're doing. So publish the data.
Thank you. Publish, and be transparent.
Yeah.
Jeffrey, last but not the least, over to you.
Yeah, I think my actionable steps especially for issuers and corporates, as Christine also mentioned, that I think many issuers feel overwhelmed about the fact that, when it gets to sustainability, it gives me stress, and people do freak out. But I do want to emphasize the fact that we are not so much grumpy people. We are a very nice group of people who are trying to help. There are data providers like CDP, there are standard setters like TPI, there are service providers like Moody's who can help on helping you in terms of communication with the investors and lenders. And obviously in Asia, we have a very positive policymakers and regulators who are really providing that support from the top, which is trying to help on that transition financing and the journey. So let's not be too fearful, and I guess we can all work together in order to make things happen.
Thank you. Last but not the least, I want to mention that banks are here to help too. I actually prepared a 30-minute closing remark now. I think one thing that I do wanted to borrow from what John mentioned that was stuck with me. We're not going to be economically sustainable if we're not environmentally sustainable. I think that pretty much says it all. I think regardless of this being transition finance, sustainability initiatives, reporting, planning, regulation, investor relations, I think that really boils down to that one. So with that, I'd like to extend a big thank you to our panelists for sharing their views and expertise with us today. I, for one, surely had a lot of takeaways. You probably saw my notes offline. And also thank you to the audience for your time and engagement. We hope that you find the session interactive and insightful. With that, we'll pass the time back to Jenny for the closing remarks. Thank you very much.
Great. Thank you so much, Serena, for the excellent moderation. It's been wonderful to hear you navigate this very complex space in a very short space of time. Also, John, Christine, Jeffrey, and David for these very pragmatic and I think practical insights. I definitely have walked away with a lot of different quotes. Preparedness, readiness, maybe competitive advantage, whole industry approach and collaboration is needed, and we need to be looking forward at metrics, data, and approach. So, with that, I hope for the audience, there are a lot of resources that are available. We hope that you found these insights helpful on some of the data and tools and implementation. We encourage you to really read up on Hang Long's discussion paper on their journey to net zero, how they are working across the value chain and stakeholder engagement, because this is a real case study, particularly when it comes to addressing embodied carbon and really like scope 3 and value chain emissions. Also check out TPI, CDP websites on kind of like the data and metrics available, and also all the assessment tools that are available to you as well. So with that, I'd like to close off this session. Our next webinar will be in May, where we'll be focusing now in terms of the asset managers and taking a deeper dive into how they are looking at transition. So if you would like to also claim your CPT points, please don't forget to complete the survey at the end. And I'd like to thank the Secretariat team as well for this great organization. Thank you.